Schwab Asset Management is proud to support the Inside ETFs podcast. In today's complex world, Schwab Asset Management provides a simple, straightforward approach to investing. As one of the largest and most experienced asset managers, they offer low-cost core ETFs for building the foundation of a diversified portfolio. Their focused lineup, which includes market cap index and strategic beta ETFs, is a reflection of a commitment to deliver exceptional experiences to investors and the financial professionals who serve them. Learn more at schwabassetmanagement.com/ETFs. Hello and welcome to Inside ETFs, the podcast where we bring the latest and greatest ETF industry perspectives directly to you through in-depth conversations with key thought leaders from across the ETF ecosystem. I'm your host, Douglas Yones, the head of exchange-traded products at the New York Stock Exchange, the home of ETFs. Now, today I'm joined by Arne Noack. He is the head of systematic investment solutions for the Americas. Arne joined DWS in 2007, and prior to his current role, he was the head of ETF product development for EMEA, covering ETFs as well as non-listed structured funds for both institutional as well as private client distribution. And of course, many of the advisors out there are very familiar with the DWS lineup of ETFs, either under the name DWS, of course, their brand name, the X-Trackers funds. Arne, thank you so much for being here today.
Thank you so much for having me, Doug. It's really a pleasure.
Arne, I want to start at the beginning. How is it you sort of ended up in the ETF industry, how you were here in the States? You know, when you sort of look back at your career, was there a spot that was really a pivotal point that you look at and say, boy, that's really kind of how I ended up in this spot?
Very interesting, Doug, and thank you for giving me the opportunity to reminisce a little bit here. So sort of going back in time, back to 2007, I was fresh out of university, April 2007, and I joined Deutsche Bank at the time in London. And the team that I joined happened to be tasked at the time to set up our ETF business regionally in Europe. I have to also admit that when I joined that team, I did not know what an ETF was. I had never heard the acronym ET and F at all. And so the learning curve for me was very, very steep. And talking about the pivotal moments, there were several. In particular, the first one was the onset of the global financial crisis in 2007 and then 2008 and the first half of 2009, which really proved to be a boon for ETF investments globally. So we were very successful in Europe, launching our strategy there. And then fast forward 2015, I was asked to join the team here in the US as the lead for product development. And in February 2015, I happily obliged and joined the team here in the US to help with the build out. That for me was another one of those pivotal moments, because the 8 years that I had spent in London, I both could apply to some degree here in the US, because of course I was very familiar with the ETF market in general. However, also recognized how important regional differences and a regional differentiation in terms of overall business strategy is. Because although, ETFs in Europe and ETFs here in the US have a high degree of similarity, the underlying market, the market structure, the use cases, the clients who use them, the exposures that are in demand, all of those nuances can be substantially different. And the idea that I had personally was that I could transpose some of the strategies that we had success with in Europe over here. And I very quickly learned that it's not as simple as that. So for me, the last 7 years here in New York have been a great learning experience. I personally have the ambition to always be as humble as I can, that I come in with a beginner's mind, as they say, because I am a foreigner here. I did not grow up in the US market, and so I have a lot to learn, and I want to make sure that I learn these lessons well and apply our team's talents, our hard work, and our efforts to the best of our abilities for the benefit of our clients and their investors and their clients.
It's funny you bring up so many of the points that just sort of tend to come up in this podcast. We talk a lot about career development, especially in the ETF industry. how this industry continues to grow and thrive and be amongst the fastest growing portion of the financial industry. You also bring up an interesting point that comes up time and time again. ETFs tend to thrive and break down barriers during times of significant market stress. You mentioned the 2007, 2008 time period. Even now in this sort of historical moment where we're entering bear market territories and possible recessions, I read a report that in the last week, the only place that continues to bring net cash flow in is the ETF industry. So ETFs continue to sort of thrive in these time periods, boom as well as bust. Is there something that an advisor out there, someone listening in on the podcast, might be surprised to learn a little bit about your role and some of the work that the Xtrackers team does over at DWS?
I would say yes, and I would actually very much invite all of the advisors listening, if they're curious, to come and engage with us, because I would say the one thing that also keeps me here in the seat is the flat hierarchies that we have. There is essentially, we're all very hands-on, and including my global boss, Fiona Bassett, who runs the passive business here globally. We're very much involved in all decision-making processes. We try to socialize all of our decision-making as much as possible. We really value the input of all of our team members, from the more recent joiners to the most junior team members to the more senior team members. All opinions are very much welcome, and that, frankly, let's call it, and I think it's been well written about, the democratization of investments and the role that ETFs play in this is really something that we take seriously, not only by virtue of the products that we deliver and the ETFs that we make available to our clients under the Xtrackers brand, but also by way of the culture that we want to instill here. Because we don't want anything top down, steep hierarchies, the person at the top leads. It's very much that we're all in this together. If the person from the top, we're expected to lead from the front, So it is very much my pleasure to be fully engaged in advisor-led conversations, to be at the conferences, to be available. That's really what we're all about. The one thing that I quite desperately want to avoid is that we who lead the business, or who've been entrusted with leading the business, we're out of touch with reality, and we're in some kind of ivory tower. That to me personally is a bit of a nightmare scenario. So I want to do my utmost to be as engaged and as available to our client base as I can possibly be.
Yeah, let's stay on the topic a bit, because, the DWS Xtrackers lineup, well known, well established, but certainly has changed over the years. Could you talk a little bit more about some of the evolution of your ETF lineup, the ETF business?
Yes, with pleasure. And for my comments, I'd love to focus in particular in the US, because of course, that's what I would expect to be the most relevant. So if you look at the US portion of our business, we're relatively young. The ETF brand, Xtrackers brand that we have now, was launched here in 2011. And between 2011 and I would say 2015, so for our first 4 years, we were really known as the currency hedge guys. We had a very strong lineup of currency hedged equity ETFs in particular, so international equity exposures with a currency hedge overlay. Some of the ticker symbols that might be familiar to you and our audience here might be DBEF, which is the currency hedged EFA tracker, DBEU, which is currency hedged Europe, or DBJP, which is currency hedged Japan. And really, our current success and our current lineup really banks on those. They were the foundational elements of our US platform that were laid in 2011, but really only came to thrive in the years of quantitative easing abroad, in particular in Japan and in Europe, or the Eurozone in particular, where you had equity markets locally going through the roof, local currencies tanking, and of course, given that those dynamics are both at play in an unhedged framework, people who were invested abroad, US investors who were invested abroad, realized all of a sudden that although local markets were going through the roof, their bottom line didn't really move, because everything that they gained on equity, they lost on currency. So we, at the time, really had the right product at the right time. We raised assets, I want to say in 2015, going from just under 5 billion in the beginning of the year to being just under 20 billion large at the end of the year. So really, it was a hugely successful year for us. Of course, we also did realize at the time that being a one-trick pony is all well and good when that one trick is in demand. If that trick is out of favor, we're out of luck. And given that at the time, the currency hedge trade, as was known, there was some uncertainty how long that currency movement together with the equity market could be sustained. So we made a big effort in diversifying our product range from 2015 onwards, which is actually one of the reasons why personally I came over and why I'm actually so enthusiastic about having come over, because what we did, sort of banking on that currency hedge lineup, we built out a range of very strong fixed income ETFs, in particular high yield ETFs, HYLB, HYUP, HYDW are some of the tickers. And really HYLB launched in 2016, disrupting the duopoly in the high yield bond space here in the US by essentially bringing to market a Me Too product and at significantly disrupted expense ratios. We're now HYLB at 15 basis points, really is a commodity fund, several $1 billion large. Separate to that, one of the topics we really wanted to own for ourselves is the topic of ESG, or environmental, social, and governance conscious investing. Us as a European firm, for us, it's critical for us on the agenda globally, and we want to be seen as being on the vanguard here, being on the front here, leading that conversation with regards to our ESG product range. We now have 10 products, just over $4 billion in terms of assets under management in those ESG products. And really that is an important component for us as well. And last but not least is China, or unhedged emerging market exposure, where with ASHR we have essentially one of the largest and most liquid China products here in the US. So we've chosen our segments well. We do not compete with plain vanilla products such as S&P, plain vanilla S&P 500 exposure. We have S&PE, which is the ESG version of it, but we do not compete with, let's say, the likes of SPY or IVV, VOO. That is not something where we can add value. So we anything that advisors can see from us, you can rest assured that we've thought well that we want to compete and how we want to compete in the market, and we intend to bring a very clear value proposition to the market and advisors here.
Yeah, I mean, clearly, Arne, you and the team have continued to innovate. You're tracking exactly where advisors plan to be before a lot of times people are thinking about that. Here we are in 2022. When you look at the markets right now, are there places that you're saying, hey, this is where we need to innovate? This is where my team is focused on product development?
Yes, so something that is front and central for us, and I alluded to that already, is the topic of ESG, or environmental, social, and governance related investing. Of course, here in the US, the conversation on that does not take the same shapes as it does in Europe, where a lot of the conversation and a lot of the asset flows are almost regulatory driven by regulation. Here, it is more a desire by investors and financial advisors to be well informed and to be conscious of the fact that non-financial metrics, which typically tend to be found in the ESG world, actually do have an influence, or can have a significant influence potentially, on financial outcomes of companies. So how do we integrate ESG data points into sound financial decision making processes? And that is something that we want to be a partner to asset managers, asset owners, as well as financial advisors too. Not only a product provider, of course we want to be a product provider for that, but we want to be much more than that. We want to be a thought leader, we want to be a partner, we want to be someone who can offer resources. So with that ambition, of course, our product development right now is very much focused on this. The overall scheme of things I would characterize as we want to give a very similar looking toolbox with ESG metrics that is available on the non-ESG side. So to give you some example, we have the S&P 500 ESG ETF. It was the first one here in the US. S&PE is the ticker, is close to $800 million large, so substantial, and really is a plain vanilla, large cap core type of exposure. Following on from that, there's the MSCI EFA ESG leaders, which just is a transposition, if you will, of standard MSCI EFA international exposure. Same for emerging market. The slicing and dicing goes on the fixed income side. We're looking to bring to market additional sort of widgets, if you will, to allow financial advisors to really transpose their investment process that they have already established on the standard, non-ESG side into an ESG world, and be able to offer comprehensive portfolios to their clients there.
So when you look at 2022, we're in historic volatility. Seemingly no part of the markets can escape what's happening in the space, right? We're seemingly in a bear market in almost every category. What do you look at when you're speaking with advisors, and where do you say, hey, here's the biggest challenge for 2022, but here's how investors and advisors should be managing their risk?
Right. So that's always a little bit tough to pick the biggest challenge out of the many challenges that are out there. I would say one of the key challenges that probably is front and center of everyone is inflation. Of course, another one is, let's say, the fear of recession and possible market downturns that are related to recession fears, and both of those components can be addressed slightly differently. Do you want to be long standard nominal bonds in an inflationary environment? It's not that advisable. It is quite a good suggestion to do that in a let's say market downturn that is more led by fear out of recession. So we're calibrating these conversations. A lot of our advisors on their side looking at possibly real assets that could be in the form of REIT exposure or otherwise, for the purpose of mitigating possible inflationary impacts on their portfolio. Or then, for those who really want to simply protect the portfolios and don't necessarily have a desire to move into cash, what are some options around standard nominal bonds? It could be investment grade bonds. For those who are a little bit more risk oriented, what are potential options in the emerging market space? What are potential options in the high yield bond space? And those are ongoing conversations. I unfortunately don't have a crystal ball or a great tip. I know I'm asked that often. What is your best thing at the moment? I tend to shy away from these. I like to keep the conversation a little bit more nuanced and tailored to the specific requirements of each individual advisor, or frankly, each individual portfolio.
Let's talk about another piece, though. You mentioned this earlier in the evolution of the DWS lineup, the idea of currency hedging, because that's certainly a topic that's in play today. It's something that people are starting to look at, whether you look at inflation, perceived inflation, higher interest rates. Suddenly currencies do come into play. More and more advisors are looking at a global portfolio in front of them where they're starting to think about currencies. How should advisors think about FX? How do they think about hedging? What do you usually share with them in terms of best practices?
I love that you bring up that question and that conversation, Doug, because it's extremely relevant. Having come over here from Europe in 2015, as I said, I realized very quickly that by and large, US American clients have a very significant, I would call it home bias. I don't even necessarily want to call it a bias, because I think the significant overweight of US assets in client portfolios makes a lot of sense for US American investors, simply out of currency risk considerations. If you think about, and I will get to the equity side in a moment, but if you think about the fixed income side for a moment, why is fixed income in a portfolio? Generally speaking, it's for the purpose of risk mitigation. It's for the purpose of being able to somewhat predict returns with limited volatility inside a portfolio. That you get if the currency that your fixed income asset has is the same currency as your liabilities. So essentially, let's say if you're an end investor, you have certain bills to pay, be that tuition or you're saving for retirement. Typically, your liabilities here in the US tend to be in US dollar. Therefore, on the fixed income side, you invest in US dollar denominated assets. As soon as you deviate from that, it's no longer really a fixed income. It is a variable income, because all of your coupon payments, your principal repayments are converted from a foreign currency back in the into the US dollar. So you move away from fixed income into variable income. So I just make that illustration leading to the point that as soon as you introduce foreign assets into the portfolio, you have more than one risk or return source. That is the same for fixed income as it is for equities. So naturally, what that means, any desire to diversify equity exposure is naturally, one of the natural options is to move away from US assets into international stocks. You can take the German market, you can take the European market, or you can take the MSCI EFA as a broad benchmark for developed markets or emerging markets. It's all the same. What not many people realize is as soon as you diversify internationally, you all of a sudden have two sources of risk in your portfolio. You have the stock return and you have what happens with the currency. That I would say prior to 2014, 2015 was maybe understood, but the dynamics were not well recognized. And in particular in that environment, when both of those risk sources go in completely opposite directions, they cancel each other out. You diversify, but you don't actually gain anything. So in addition to this, what I would say is, do you really want to have both sources of risk in your portfolio? And if you do, that's well and good. The only thing I would say to this is have a view on it. Are you being compensated for that risk? Because you have a view on the equity, you invest in German equities, be that BMW, Volkswagen or whatever, because you like that company. But when you do that, you implicitly also take a bet on the euro. If you do invest, therefore, in the foreign stocks, you must have a view on the foreign currency. Is it going up? Is it going down? Is it going sideways? Be conscious of what your view is. Be conscious where it's going. If you decide that you do not want to take a view, if you decide that, frankly, it might go down, or you don't even want to take a risk of taking it of the currency going down, consider a currency hedge position. Why? Because all of a sudden you have a product, an investment vehicle that gives you exposure to the equities and mitigates the risk from a foreign exchange perspective. It makes for a potentially much cleaner version of being exposed to international equities than having a position, if you will, of equity risk and currency risk. So those are conversations that we very much encourage advisors to approach us on. We have tons of white papers together with our research team from the research house, DWS Research House, that show what are the effects on the individual markets, be that EFA more broadly, Japan in particular, or any foreign market, and are investors being compensated for the two sources of risk that exist in unhedged portfolios? And if they're not, we encourage them to consider a hedged position.
Yeah, so powerful. And for those advisors listening in, again, I encourage you to go to the website dws.com or you can Google any of this. The team, Arne's team, puts out just tremendous research. And I think your point you made around you're making an expression or a decision around investing. You also need to think about the second piece of that investing, which is, do you have an opinion on the currency? And the fact that the DWS X trackers offer solutions on both sides of that opinion, and you can choose, is so powerful and a very important part of being an advisor. When you look at the market right now, Arne, and you say, boy, some things can look negative, those negative items oftentimes are opportunities, and for when we look at the markets, when you look at opportunities, are there ETFs in your lineup that you say, hey, these are potential solutions to seize the opportunities in the market today?
Yes, I would say there's a bunch of them. And to your point, we saw this, especially this year, exposure such as Chinese equities or US denominated high yield bonds being significantly under pressure. The flip side of that is now high yield bonds carry a very substantial yield. And for investors who believe that some of the risks in those markets overstated, the carry or the yield available from that exposure can provide a very interesting element of diversification for their portfolio. Similar for Chinese stocks, in particular, the current and most recent talk around potential easing around US tariffs, that could be potentially supportive for Chinese companies, as well as, of course, for certain US names. But every drawdown tends to, as you say, Doug, present a possible opportunity for future development. So, there is pain in the market, that is for sure. If I remember back to, we were reminiscing a little bit earlier, if I remember back to my starting years, 2007, 2008, and then 2009, there was significant pain in the market back then. And at the same time, there was significant opportunity for those investors, advisors that positioned their portfolios, their clients' portfolios correctly at the time to participate in the rebound and in the bull market, frankly, that then followed from then onwards.
Yeah, I always reminds me of my grandfather every time. My grandfather would always say, there's a positive in every negative. And I guess that was just a different way of saying there's a silver lining. But it didn't matter what I had to say to him. He always said, no, there's a positive in there. You have to go find it, and really shaped me into who I am today. Is there an ETF, Arne, you look at in your lineup and you say, boy, every investor, every advisor, they should know about this ETF. It just, for whatever reason, hasn't gotten the spotlight that it should have, and we should be talking about it?
Absolutely, and thank you for giving me that platform. So I'll shoot my shot, as they say. The two tickers that I would highlight here are in fact mid-E, MIDE, and small e, SMLE. Both of them are ESG funds, and they're actually, in my opinion, very unique ESG funds, because mid-E, MIDE, tracks the S&P mid-cap 400 ESG index, and SMLE tracks the S&P 600 small-cap ESG index. Both of those exposures, in particular mid-cap, arguably are very interesting exposures, and historically, if you look back several years, mid-caps tend to outperform large caps fairly interestingly with a on a both a risk-adjusted basis as well as an absolute basis. So those two funds are relatively new in our lineup, and in my view have not yet received the deserving attention that I would love for them to have.
Perfect. A good opportunity for advisors to go do a little research on the DWS website. Along those lines, investors, advisors, they're out there. You mentioned about engaging with you and your team. Is there a right way to be contacting your group to talk more about whether it be ESG, your ESG lineup, your fixed income lineup, currency hedging, how to think about that in a portfolio? What's the best way that relationship should kick off?
Yes, I would say make it as personal as you can. So if you know someone who works at DWS, if you have a regional sales representative, and we have around about 40 regional sales representatives across the country that sell both, alternatives, passive, which is our ETF business lineup, or actively managed mutual funds. So if you do have a contact, please make sure to reach out to them. We want the personal touch points. That in my opinion always serves best. If you're not so much into having the personal touch points, or if you want to do a little bit of research on your own, I would very much encourage you to go to our website. That could be dws.com, or it could be xtrackers.com, it could be etf.db.com. All of those URLs lead you essentially to the same thing. And there's as Doug, as you were saying before, we have a ton of resources available there. There's also, of course, group email boxes. We make sure to be as responsive as we can. If you fancy, please do, of course, also feel free to get in touch with myself. We really want to make sure, and personally, the message that I really want to make sure I bring across is that we are approachable. We want to be a partner to you. We do not want to simply push product onto you. It's not a cookie cutter sales process that we want to follow, but we want to make sure that we use and utilize a consultative effort and process in our client engagement.
Yeah, perfect. And of course, depending on when you're listening to this podcast, if it is before the Inside ETFs event in Florida, I know the DWS sales team will be there. They have a booth. I'll be there as well, and hope to see many of the advisors there. That is a wrap on this edition of the Inside ETFs podcast. As a reminder, you can find this episode as well as many other episodes of the Inside ETFs podcast on the New York Stock Exchange's website, homeofetfs.com. Thank you, Arne, for being here to share your insights. Stay tuned for upcoming episodes featuring thought leaders from across the ETF ecosystem. I'm Douglas Yones, head of exchange traded funds at the New York Stock Exchange, the home of ETFs. Schwab Asset Management is proud to support the Inside ETFs podcast. In today's complex world, Schwab Asset Management provides a simple, straightforward approach to investing. As one of the largest and most experienced asset managers, they offer low-cost core ETFs for building the foundation of a diversified portfolio. Their focused lineup, which includes market cap index and strategic beta ETFs, is a reflection of a commitment to deliver exceptional experiences to investors and the financial professionals who serve them. Learn more at schwabassetmanagement.com/ETFs.